Greetings, Dr. Jeffrey Scott here, and I'm going to do a quick update live from Udaipur, India, where we are at a wedding extravaganza. Um, Crazy. Um, I title this one NVDA Expectation Breaker. What is an expectation breaker? To me, an expectation breaker is when you think something's going to do something and the market goes in the opposite direction. And, you know, if you look at the futures overnight and at the open and you look at where the market closed, and we'll talk a lot about it, that was a big expectation breaker. That's not a good thing. And it brings to me the question of now that we've broken through the 50-day moving averages on the major indices, do we have to start thinking about the 200-day? So again, November 20th, 2025, my name is Jeffrey Scott, market MRI Pro at gmail.com, Google Group Top Down Trader, and website marketmripro.com. And in yesterday's video, I did talk about that. I didn't think we were at a bottom, and I thought it would be a good place to take profits. Hopefully, you have a lot of cash raised, because if not, then you're feeling some pain. This session is for educational purposes only, and any recommendation in the spirit of education, not investment advice. The intent of this video is to demonstrate tools of top-down analysis, how I apply them. Trading involves risk. You are solely responsible for any investment decisions you make. I may own or intend to buy or sell any stock mentioned in this report. Trading stocks and options should be considered risky. You should always consult with your financial advisor before making trades. And I have tools for multiple platforms, but I'm an independent trader. My Google group is called Top Down Trader. Just sign into Google Groups, go to all groups, look for Top Down Trader, and let us know how to contact you. You'll get invites to private educational sessions. Some discounts will be available for my technology when it's not on sale for things like Black Friday. And you can reach out to me with any questions that you have. Old slide, but one I keep showing because good reason. I have been so concerned that we might see a bigger pullback here, and the reason is we've had a cluster of Hindenburg omens. And when you look back at the confirmed signals going back, here's just to 2018, you could see when you have the wide bar, you get the deep sell-offs every time. So reason enough for me to be concerned. Now, can you ride this out? Sure. If you look a year later, on average, markets were up 6%, but 20% of the time they were still negative. Well, the leaders were consolidating at the 50 and they broke down. So I think this is a bigger problem. And I talked about yesterday's video that if we don't hold at the 50, I think that this market is going to go lower. And I think that's my concern. Now, I don't have a crystal ball. I don't know more than anybody else does. So I'm always going to be open-minded that we could do a bear trap here and reverse higher. I kind of think this was a bull trap and we're going lower, but I'm prepared. I'm prepared because I've raised cash, as I've been telling people to do for the last 3 weeks. I'm prepared because I'm nimble. I don't manage other people's money, which gives me the ability to go back in on a dime if the market demonstrates that it's going to go higher. Right now, I'm pretty comfortable with probably between protected money and cash over 80%. And when I say protective money, I've got some longer term positions that I put puts on. And if the stock price drops and the put is at the prior price of the stock, then I can always sell it at the price it was at the strike price of the put. So still like cash to me. Know your news and earnings on Friday. You've got some Fed speakers, you've got some PMIs, and final consumer sentiment. I futures when I last looked are up a lot, but compared to where they were going into the market yesterday, the futures are not as high. And we know what happened in the market on Thursday. If you look at earnings on Thursday, you have BJ's Wholesale and a few others. Frankly, the one stock I held into earnings, which may or may not have been the right thing to do, but turned out okay, was Walmart. And you'll see consumer staples was the one thing that did well or held up on Thursday. It's a judgment call to hold stocks over earnings. It's a bad judgment to not know when your stock's earnings date is scheduled. For more information about anything I talk about, just reach out to me at marketmripro@gmail.com. I'll answer every email. And if you have a question about something you're interested in or you'd like me to demonstrate, what I'm likely to do is to just demonstrate it within the program on the next video. And if you have any issues with installations or any problems with the software, coding at marketmripro.com, consider joining my top-down trader group and visiting our website at marketmripro.com. To those of you who found out about me through the recent launch of Metastock version 20, I use my own app for most of these videos. I am starting to prepare a bunch of videos with the new Metastock tool, and I will be starting to incorporate that in my videos as well. For those that don't know why I would do that, Metastock offers a lot of opportunities for all of us. It has markets outside the US, which allows people to look at India and others. And I know there's a large number of traders of the Indian markets. Metastock has some charting ability that most other platforms, including mine, won't have. And I have the ability to scan for trend lines, trend line breaks, bounces, etc. So there's a number of different things in Metastock, so it becomes complementary to what we're doing here. See you in Florida in 2026, and I forgot to put a slide, but I will be doing on Friday. Let me just do the slide live while I'm talking to you. And so that, whoops, hit the wrong button, Jeffrey. Go in here, type new slide. And we're going to go live Black Friday event. And I'll put 10 a, I think I did 10 a.m., 10 a.m. Eastern Standard Time, Friday the 28th. Market review live. Special launch announcement. Those who are at my live meeting will know exactly what I'm talking about, but we're going to launch a update of the current program, which will now incorporate a second educator's tools at a price that is significantly lower than he's ever offered his set before. And that will, you'll have a couple of different ways of attaining it. You can buy it freestanding. You could buy it update to the current market MRI program. You could use either product individually or combined. So very excited, and info and link below to sign up. So hopefully you can join us on Friday before you go out shopping. And I do plan on holding another event in Florida in 2026. You know, we had more people show up live than I would have thought, which was very gratifying. We had a great time. Still appreciate the online folks as well. And so I'm going to do it again. I have so much fun at those meetings and guaranteed you'll gain 3 pounds. All right, so let's take a look at the markets. Let's start with the daily briefing, which I used to just to see what happened. And the thing that was up the most is volatility. That's never a good thing, but at some point the volatility will become our friend when it starts falling. When it's rising, it's our enemy, and you could see close right at the top. The dollar holding up well as the markets sell off. Maybe that's not a surprise. At the top of the range. Everything else closed at the bottom. Diamonds were down 0.8, Spider 1.5% down, Russell 1.85 down, Q's 2.37 down, and Bitcoin was down 3.49. Bitcoin, every rolling 5 days is looking 12 or 13%. Bitcoin's in a world of hurt. Those are bad numbers, especially when you consider that if you look at the high of the day, you were up almost 2.5% on the Qs, and you close 2.37. There's a major, major negative move, and you could see the drops from the open. So what a bad day in the U.S. markets. If you look at new highs and new lows, NYSE and the NASDAQ, I pretty much key on the 12-week category, although the 12-week new high, new low number is something that is meaningful, but I usually chart that. And you could see here, minus 71, minus 141. Bull markets are not built upon new lows, so that's bothersome in the markets as well. If you look at the S&P 500s, the only thing up on the session was Staples. A lot of that was probably Walmart. One day change 0.72. Everything else was negative. Tech down over 3%. Industries 1.68. Materials 1.49. Discretionary 1.49. And the only theme that was working is the one theme I don't care about, which is cannabis. Interestingly, the home construction ETFs were only down a teeny bit, and that's probably because rates fell with the markets. The worst performers on a one-day move, uranium, a data center, and you thought might have gone up, down 6.7, silver 5.39, gold 4.48, metals, mining, semi, solar, copper, blockchain, a lot of things that a growth stock investor like myself like to see go higher. Here we're looking at three different indices. We're looking at sectors positive on Thursday, 0 versus the day before, industries versus the day before. Advances only 28%, the S&P 1500, 24% in the NASDAQ, 23% in the NYSE. Even when the markets had gapped up and looked strong, we still had some issues on breadth. Not a surprise that it sold off. It was a tough day in the U.S. markets. All right, one thing to recognize in the markets today, or yeah, it's today. I have to remember India's different time zone. Different. We're already into Friday. In the markets Thursday, volume was super high. Now, a big sell-off on high volume could be climactic in the end of it. I think this was reversal on high volume, which is more concerning. 25% higher than normal, double-digit percent higher than normal on the NYSE, 25% in the NASDAQ. This was a big volume day, which to me makes it more concerning. If I look at the timing model, what you'll see is on the weekly model, we're holding up except for the Russell. And if you look at where the indices are in relationship to the WMA, a down day today could flip us into weekly sales throughout. So if we do, we've transitioned from a pullback into an uptrend until a downtrend. And you have to be playing the market defensively here. I don't know how you could be aggressively long unless you are playing one or two stocks that you know very well that will do what they want to do independent of the market. If I look at the dailies, you could see the stiff sell-offs that we saw in the markets today, just big. These are bearish engulfing patterns. Failing to break through the WMAs, that is not a consolidation day where you expect it to go higher. You got to expect this market to go lower. Hope it doesn't for those that are still long, but I would be expecting markets lower here. And again, feeling pretty happy that I'm on cash, not trying to rub that into anybody except play every one of my videos for the last 3 weeks. It shouldn't be a surprise. Look at the move we had. Now, we had an undercut here, or trading down in the same area here. Let's just draw a trend line in there, or a horizontal line. So we undercut. Perhaps we undercut and rally, and that was it for the sell-off on the massive volume. That would be great. Look at OBV, negative. I don't think that happens, but I think that's possible. Where's that 200 sitting at? That 200 sitting at, I can look right up at the upper left. I always forget to look there. The 200's at 614. We close at 652. That's another 7% down. It would not be a shocker to me to see us pull back that far. And don't want that to happen, but I think you have to be considering that while every day we're going to look for evidence of a bounce. And one thing that my tools are really good is finding bounces. So breakdown on the spiders, pretty obvious to me. Now maybe that, again, we bounce, who knows? I just don't see this as I'm bouncing the next day calendar. Now, what is likely to happen, certainly at the open, after the sell-off that we had, for us to rally up, perhaps to close to that 50, and then break lower. You know what, I should be using a different tool. Would not shock me. So if we finish up higher today, unless it's on massive volume and we close above the 50, I think it's just a relief day bounce after a big sell-off day. I don't expect us to reverse here. And again, close was at 585. The 200's at 543. That's 42. It's less than 8%, 7 to 8%. I hate to even look at that 200, but I think it's got to be viewed as potentially in play here. Looking at the cues, the pattern doesn't change, big breakdown. And again, is that what you expect in a reversal day? No, you expect it to open down here and close up here, or you expect it to open here all the way down and then reverse and close higher or close to where it opened. Those would be bullish reversals. This is a bearish looking reversal to me, and one that has me concerned about where this market's going over the next couple of weeks. Again, we have great seasonality, but seasonality is trumped by technicals. You look at the Russell, same picture, and 220, 229, 4% away. I look, is it the end of the road if these pull back to the 200s and bounce? No, it's a great buying opportunity. If they fail there, it's a whole different story. Um, the VIX, right now the VIX is not our friend. And I know George says when the VIX is high, it's time to buy. When the VIX reverses, opens here, or opens here rather, trades all the way down to here and closes there, that's a reversal. When you see these big tops on the VIX, that's a reversal. That's not a reversal. That's opening here and closing just off the high of the day. How high is this VIX going to go? But when that VIX reverses, that's the time to buy. VIX to me looks like it's going higher. And the dollar, you could see, we talk about it every day. It's well off the prior highs, but the dollar, let's just go back and look at the last 50 bars, consolidating after a big sell-off, but definitely trending higher here. And we'll see how high it goes. If we look at the commodities, this was not, there were no safe havens here. Gold consolidating, as is silver. Oil can't get above the 50 and the 200. Natural gas had a little bit of a reversal candle. We'll see if it's meaningful. And you could see bearish engulfing patterns on let's see if it really is. This is the 10-year rates. And on bad days, rates typically will go down. It's not really a bearish engulfing, didn't capture that, but that's a pulling back candle, a bearish candle, which is good if it's about rates and they're down 0.5%. And when we look at the 30-year, similar candle filling at the 200, down 0.36. These two candles are probably why home builders were actually up. If we look at the buckets, we've shifted to the left and we've got a lot of stocks at below their bands, 19% in the NYSE, 18% in the NASDAQ, 15% in the Russell 2000, and 18% in the S&P 1500. Now you're probably thinking to yourselves, Jeff, that means we're going to bounce. No. I just want to remind you, if you haven't seen what bad looks like and why I put my video on April 7th that the market is bottomed, because that's what it looked like when the market bottomed. We are nowhere close to that. I don't think we will get close to that. I think we will bottom at least short term over the next few days. The question is, how much lower will we be? Could we bottom right here? Absolutely, we could bottom here. Maybe this is the bottom, the high volume sell off. I just I'm not putting my money to work right now. I don't have enough data to support that. Looking at market breadth, I'm looking on the left is the NYSE composite. On the right is the NASDAQ composite, and two ugly candles, very similar on the NASDAQ composite as in the Qs, a bearish engulfing pattern taking it 1, 2, 3, 4 prior days, failing at the 50, and not even even worse. We've got in the John Person, we're in a low close low close doji, a very a bearish looking pattern here, with a big topping tail. Both of those look like they want to go lower. You can see stocks above the major moving averages are working their ways down. And then the breadth indicators, new high, new lows are negative on both. AD lines are negative. Up, down volume is negative. Down here are a number of things that I look for at a bottom. And if I just go back to that April bottom, I'm looking for these green bar called a Eureka would tell me something's changed. This is my defibrillator indicator, which fires at bottoms. This is a bingo, which is the baby out with the bathwater. Those are what I expect to see at a bottom. We have none of those right now. I do not think this is a bottom. If I look at my market breadth with the new high, new lows, and you look at the new high, new low percentages, they actually improved on Thursday. So again, could it be a bottom here? It could be, but it's not low enough typically to be the bottom. And do I see any turning up of the AD lines on any of the majors? Spider, NASDAQ Composite, Russell 2000, or the S&P 1500, nothing. I just don't see a bounce here. Let me say it differently. I don't see a end of the pullback here. I could see a bounce. I'd expect a bounce today, but I think we learned about bounces yesterday. They don't always, and as I said it yesterday, it's where it finishes or where it closes that matters. What else can I tell you? If I look at the ratio charts, it's clearly technology's fallen out of bed. Not good for the markets. But if you look at in discretionary also, but the defensive plays that would include staples and utilities and real estate are showing life. Never good for the U.S. markets, in my opinion, when you lead by defense. And healthcare continues to be on top. If we go to the JAS layout, um, hard for me to even want to talk about top down or bottoms up because who's buying in this market? And, I'd be very careful adding to long positions. If you look at what the leaders were yesterday or Thursday in returns, just look at staples because that was the one thing in the S&P 500 that was positive. Well, why isn't it positive on mine? Because I'm looking at 161 stocks, which is much more than in the S&P 500 for staples. And let's just kill anything less than $5 or 500,000 shares. And we're left with 86. And let's rank them by how many positive impulses. And you could see there's not many with positive impulses. So let's just look at these very quickly. Walmart, how did I know this was going to? I didn't know this was going to happen. It's in a nice uptrend. I'm in it significantly lower than the current price. So I figured I could take 5 to 8% pullback and it had earnings. And what did earnings show? Um, not a lot of growth, but a little bit of surprise on earnings and revenue, and the market liked it and must have beat some whisper numbers. And if you want to know why it popped, uh, more online customers, more people in their stores, you could read about it in the news feature. Um, it's SMPL, another staple, not my kind. This is one that's definitely a bottom dweller, but it's got a CPR, an EMS and a CPR, and it had a momentum and a breakout signal coming out of a squeeze. CCCH, looks like an IPO. More foods, more foods. Robert Half, or excuse me, Herbalife, more nutritional supports. So these are things that I don't typically chase after, except for the leaders in category like Walmart or Costco. Although Costco finally gave up the moon, and you could see the rotation are not into growth stocks. These are the leaders in the market. If we look at Costco, um, let's see what Costco pops up. Come on, Costco. I know you're in here somewhere. There you go. I've always wondered about valuation on Costco, and I've talked about it several occasions. It still has a PE of 52% going forward, does pay a small dividend. $5 on a $900 stock is less than 1%. And if you look at growth rates, the growth rates to me don't support a PE of 50, and it was a lot higher when I had made those comments. So from a top-down perspective, I don't know how I'd want to be in the markets. If I look at the Contra ETFs, just out of curiosity, which are going to be the only things that show much green. The diamond, the dogs go up when the diamonds go down. And you could see we've broken out here. I would have no problem being long here. Don't let it get below the 50, and it's not a long-term holding. SPXS, which will go up when the S&P 500 drops. Praveen, if you're watching this, we're still missing the split fix here. But as you know, a opposite of what we saw in the index, a bullish engulfing pattern. This one looks like it wants to break out. Again, no problem being long that right now. SQQQ, it looks like it had a reverse split come in, so we're going to have to fix that up. But it was up. I don't think it was up 435%. I think there's a split in here. But again, a big bullish candle, and then TZA, which is small stocks. All the contra ETFs look viable here, which means the markets look horrible. So we got to send a note to Praveen to fix the SQQQ and the SPXS. Okay, I'll do that when I get done. What else? Let's just go very quickly and I take off the filters. What else popped up? Semiconductor short. SOXS goes up if semis are bad. Hasn't broken out yet, but looks like it's getting ready to run as well. Lastly, let's just go into the big list and let's look at my A's and A pluses and A's to see if anything can't qualify. These are some of my favorite setups. Nothing in the A pluses, no surprise. It was not a day to find longs. And let's look at the A's. Walmart, the only one. So I think you got to be careful here. I'm not advocating or telling you what to buy or what to sell. I'm more interested in just letting you sense that I can still feel that this market could go much lower. Um, Target's 200 for me for right now, unless I get an obvious reversal signal before then. I sit on the sidelines ready to pounce with my cash, but I'm not chasing things except maybe Contra ETFs right now to balance out whatever long positions, which are very limited, that I have left, long like Walmart. Have a great day, everybody. I'll get something out over the weekend. The timing in India is working out okay that I can do the video. So see you over the weekend. And please consider coming to my webinar next Friday where we're going to launch a new product which will get you excited.